In fact, when I think about Europe and what's happening right now, I think about the book Anti-Fragile and that concept that some entities benefit from stress. And I would argue that we may very well see that the EU is one of those entities because the kind of stress it's experiencing, while no one would want it, is forcing it to draw closer. It is forcing it to focus more on being competitive, on deregulating, a smart deregulation, but deregulating. So there are some real benefits. Now, it doesn't ensure success, but I think there's significant upside potential. And when I look at valuations, I think European stocks are priced far from perfection.
I'm Ethan Devitt, and welcome to the 50Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. This podcast series is kindly supported by Franklin Templeton and Alvine Capital. Franklin Templeton is a global investment management firm that provides a broad range of investment solutions, including mutual funds, ETFs, alternative investments, wealth management, and technology-enabled financial services. Founded in 1947, the firm manages approximately $1.8 trillion in assets under management and serves individual and institutional investors across more than 150 countries. Alvine Capital was founded in 2005. It's European-focused private capital advisory and placement agent that provides capital raising services to investment managers from its bases in London and Stockholm. It creates bespoke capital raising programs that blend appropriate investor targeting and sophisticated marketing to deliver a fundraise aligned with institutional expectations. I'm joined today by Kristina Hooper, who's the Chief Market Strategist at Man Group, a global alternative investment manager. In this role, she provides views and insights on the economy and markets and appears regularly on CNBC, Bloomberg TV, Yahoo Finance, and Reuters TV. Prior to joining Man Group in 2025, Christina served as the Chief Global Market Strategist at Invesco and previously worked at Allianz Global Investors. Welcome, Christina. Thanks for joining me today.
Thank you so much for having me, Ethan.
Well, I have been delighted to follow you on LinkedIn. We met at a conference. I followed one of your great keynote speeches, and you also featured on the Markets Happy Hour podcast. But that only whetted my appetite to hear more about your background and how you entered finance. And I'd love if you could talk us through that.
Sure, absolutely. Well, I had a very circuitous route. There's a quote from Steve Jobs that I think encapsulates my career route, which is that only looking backwards are you able to connect the dots, right? I'm paraphrasing, of course. And I think that really captures it. When I was in high school, I was super interested in politics, and I was the student body president, and I did a lot of talking and a lot of writing. And so I was always told by teachers, you should go to law school. I was told by family, you should go to law school. So I always had that in my head, and that was my ambition. And when I went to college, I did get involved in what I really found interesting, which was the college investment club. An old alum had donated money to the college and had said, I want this to be allocated for students to invest. So an investment club was formed, and a group of us were able to make investment decisions on that sliver of what was the endowment. Now, that's a lot more common today, but back in the late 80s, early 90s, it was a pretty novel concept. And so it was really exciting to be part of. And then part of being in that investment club, we would hear from different portfolio managers who would come and give lectures. And if we wanted to include something in the portfolio, we had to come up with an investment thesis and present on it. So that was so exciting and so interesting for me. But I also knew that I was destined for law school. That was where I was going to make my mark. And so when I graduated, I went to law school and I loved it. It was really interesting. But once I got out in the real world, I realized this isn't for me. Conflict is not something I enjoy. I'd much rather be helping people. And I was struck by whatever law I was involved in, because I interned and did some criminal law, DA's office, legal aid, as well as family law. People have all these disputes and issues, and I can't solve them. I'm only helping them end that conflict, and it just wasn't for me. So that's when I pivoted. But it's hard to pivot. Once you start down a path, I can understand how many people have difficulty making career changes. I was at the start of my career, but it was still hard. Luckily, my law school roommate's good friend worked at what was then Payne Webber, now UBS. And she said, they're really interested in the retirement plans department in taking legal work in-house. Like, so if we could get some kind of lawyer who could work on legal documents and not waste our money, not drive up billable hours with a law firm, we'd really like that. So I applied and got the job in the retirement plans department at UBS. Absolutely not what I wanted to do, but sometimes to get your foot in the door, you have to take what you can get and just make the best of it. And so I was working on SPDs, summary plan documents, which was, it was amazing that I was able to stay awake for the whole day because that was rough going. It was not at all scintillating, but it got me closer to where I thought I wanted to be. And I realized pretty soon that if I wanted to fully make that move and get to more of the investing side, I needed to go to business school. But it was a great first step was to get to UBS and then realize that. So a few more positions, and I did business school at night at NYU while I was working during the day at PIMCO funds. And it was, I thought, a wonderful way to learn because I saw practical applications during the day and went to school at night and made it through in 4 years. Going part-time takes a little bit longer, but it was, such a fantastic experience for me. And then I thought about, I was in my career as a client portfolio manager, then moved to more of a strategist role. And I thought one thing that I would really like to do a little bit more on is economics. I was not an econ undergrad. I just took a few econ courses. And so I did this master's at Cornell that actually had a variety of different components to it, but you could focus on one for your, what essentially was a thesis, but not exactly because it's not a PhD program, but almost your cornerstone project. And so I did it on labor economics. And to me, that was really interesting. And it was, once you've been out in the field a long time, working, and not doing any studying, there's something almost like delicious. It's like actually a treat to be able to go back and sit in the classroom that I had never appreciated before in the same way. So it was, to me, just a valuable experience. I think as we go through life, we have to pick up learning opportunities, both informal and formal, because things change and we want to learn more and we want to augment what we've already learned. So to me, it was a bit expensive, but it was enjoyable.
Funny, my mother had exactly the same view. She went back to law school after a career as a teacher, and she also used to see it as a real treat. I'd love to dig in a little bit to the topic that you did study there, labor economics, because as well as your training in law, because despite the fact that you knew conflict wasn't for you, that maybe, I'm sure, learning law influenced your writing, perhaps, if you're always a good writer, or maybe your ability to analyze in the strategy space. And equally, labor economics, what have you taken away from that discipline?
So I'll start with law. I actually think there are a lot of parallels between law, learning to write an argument and make an oral argument, and making an investment argument. So much of my presentations is to come forward with a thesis where my view is on where the economy is going to be and investment implications. And I think I learned some discipline, some rigor through law school in terms of making a coherent case and ensuring that I have the backup to support an argument. And then with labor economics, I actually became really fascinated with the concept in particular of how one could reduce a high level of unemployment. And so I dug in and spent a lot of time in my thesis project on the Great Depression and the policies that were used to help pull the country out of a very high level of unemployment. So it was really interesting to look at New Deal policies. And what I was fascinated with was the WPA, Works Progress Administration. Now, this was, some would argue, a crazy idea, but at the time, when you think about how high unemployment was, the ability to actually create a program where you put Americans to work and you created infrastructure as a result. I think many people today don't realize that some of our greatest components of infrastructure in this country were built by WPA workers. So it accomplished two goals at the same time. We were able to bring down unemployment significantly, and we were able to build so many wonderful, valuable things that I would argue were a foundation for growth going forward. So I think perhaps I was personally touched by it because my mom was a teacher and the high school she taught at was built by the WPA, and it was a beautiful building. And she would go through and point out to me, well, this was built by the WPA, this was built by the WPA. So I grew up having that sense. A lot of the parkway near our home, a lot of the bridges were built by the WPA. So to me, that was just an incredibly good use of government dollars, providing fiscal stimulus that lowered unemployment, was a high multiplier effect, right? Because if you think about it, I always get annoyed when I see that economists and strategists aren't qualitative in looking at fiscal stimulus. They think every dollar of fiscal stimulus is equal, and that's just not the case. The multiplier effect can be so different depending upon how we spend it. So to me, that was just really interesting and the greatest success story, in my opinion, that I've ever studied about lowering unemployment and doing it in a way that was very positive for the economy.
And what would you say are some of your other core investment beliefs around this pivotal role of the employment and labor economics, now that you are looking across the board at many different drivers of the macro context?
Well, it certainly is important to be thinking in terms of unemployment, but I think one also has to recognize that the economy has gone through some paradigm shifts. So, for example, what we've seen is a stock market that has been so strong over the last few years. At times when I've worried about weaknesses, for example, with the consumer, with greater wealth inequality. And so I take things like higher unemployment with a grain of salt. Now, having said that, I do worry a lot about what we could see in terms of structural unemployment when it comes to AI. We've heard it from the tech CEOs. Some have estimated that structural unemployment could get as high as 15, 20%. And so that to me is a real concern in terms of the impact on the stock market. I think we'll certainly see a number of tech-related names performing well and a lot of companies doing well, with the exception of those that have exposure to the consumer. But again, it's nuanced because we've seen a number of consumer stocks, consumer discretionary, still do well, even though the consumer has been weak. It's just been that high-income consumers have driven, the 10% have driven about 50% of consumer spending. So there are certainly some considerations that come from, for example, thinking about unemployment and where it goes. But I do have to recognize that the economy is evolving. And so it may not be as dramatic an impact and certainly may not be as big an impact on, for example, the S&P 500.
I'm thinking about a strategist role in a firm like Man Group, because I think we all know Man Group, maybe its origins with some of the CTA trading and then a very much a multi-asset manager. And what do you see as the role of strategist, and how do you bring some of this macro thinking to be actionable for your clients?
So from my perspective, it's all about offering some value, some support to clients who are looking for it. I think that as asset managers evolve, they realize that client relationships are very important. And so the ability to support clients and provide them with what they're looking for, what they need, and in some cases, what they expect is critical for the future. And so I've been at several different asset managers serving as the chief strategist, and I can say that it is such an important, in my opinion, component or a nice value add to have in a client relationship. And particularly so when you have very complex, sophisticated investment offerings. Helping make sense of what's in there, how to think about it is certainly part of it. But from my perspective, it's very much, and we also have other value add components like the Oxford Mann Institute. So there's a lot going on, the OMI advisory. So there's a lot of support for clients, but this is a nice addition. And I think it helps clients as they think about what their expectations are. So quite often I'll sit down with institutional clients who will want to walk through scenarios. What's your base case? What's your upside scenario? What's your downside scenario? And let's talk through asset class implications. I think for them, it's an opportunity to challenge assumptions, ask themselves if there are other risks they're not thinking about. And so I think of it as a very helpful process. And of course, I learned so much about what clients are most worried about as we go through it.
And I'd love to just dig into that a bit more in terms of clients' perspectives today, because you are really at the coalface there, hearing from clients, hearing whether it's private credits on their mind or the market melt up is on their mind. If you were to kind of maybe take the zoom out and do a heat map of where you think clients' sort of concerns or maybe confidence level is today, is it possible to draw that map?
It's very difficult because I think there are conflicting views on the part of a number of clients. There's definitely positive sentiment given how much we've seen in terms of stock market gains. But at the same time, there's this concern about how long this could last. What are the risks? Can we tolerate high valuations and a stock market that continues to rise in the face of a war that is not only impacting oil prices, but will be impacting the prices of a number of critical commodities whose supplies are being affected by the closure of the Strait of Hormuz. So I think it's almost a fool's errand to try to map it because I think there are clients with very conflicting emotions and it would be hard to capture in a heat map.
That's really interesting. And I think what I really loved about your keynote at the event we attended together in Washington, D.C., was your ability to look beyond the headlines into some things that we can underappreciate or overlook. And I suppose when you look at the opportunity set today, whether it be a positive opportunity you think is compelling or a concern that you think has been overlooked, is there anything that you find that you're maybe seeing a little contrarian to maybe the rest of the commentators out there?
Well, a few come to mind. So I'm actually quite positive on European equities. And my thesis has a lot to do with what I think is a European Union that has been under pressure, under stress, but I think is likely to emerge stronger. In fact, when I think about Europe and what's happening right now, I think about the book Anti-Fragile and that concept that some entities benefit from stress. And I would argue that we may very well see that the EU is one of those entities because the kind of stress it's experiencing, while no one would want it, is forcing it to draw closer. It is forcing it to focus more on being competitive, on deregulating, a smart deregulation, but deregulating. So there are some real benefits. Now, it doesn't ensure success, but I think there's significant upside potential. And when I look at valuations, I think European stocks are priced far from perfection. And of course, we have this added benefit of a rush to spend more on defense, which is part of the stress being exerted on Europe. So getting to that 5% of GDP number by 2035 means we'll see significant fiscal stimulus. And going back to my argument that not all fiscal dollars are equal, the multiplier effects of defense and infrastructure spending tend to be higher, relatively higher than a number of other forms of fiscal stimulus. So I'm excited there. And of course, there are other opportunity like emerging markets, especially Asia. I think taking a step back, one of the other areas of opportunity is just active management. For so long, that hasn't been the case. But I think today there's going to be, increasing discernment and differentiation, including in all the components within the AI universe. I think of it as not dissimilar to the late 90s and early 2000s, where there was so much excitement about the internet, about what could happen. And we saw winners and losers over time. Not everything worked, even though for a time everything worked. That had a .com on the end of it. So I think we're entering that period, and we've already started to. Now, something to worry about that I don't think many people are concerned about is the reality that U.S. Treasuries may no longer be a safe haven asset. And more importantly, that yields are likely to go up on U.S. Treasuries in particular, but also other sovereign debt from developed markets countries. That can and has historically, and in many instances, exerted downward pressure on stocks. And so I think this assumption that yields will remain relatively low could very well be erroneous, that we could see structurally higher government bond yields for much longer. We could also see, of course, a higher neutral rate going forward if a lot of the forces that are at work right now persist and we get a higher level of inflation for longer. And that's just part of the deglobalization process if that continues. So that has implications for stocks and can create speed bumps for the stock market.
We could talk about these factors, I'm sure, for a lot longer. One quick thing, though, before moving to some personal reflections. I love that concept of focusing on what's anti-fragile. And this kind of links it to the AI question, because I have seen a thesis emerge just in the past week that AI was eroding moats. So whereas the moat was the classic thing that was conferred an anti-fragility, that if AI could erode a moat so quickly because upstarts could have gained the same ground. What do you think of that danger? Rethink what is and what isn't anti-fragile.
So I think that's a valid concern. And we saw that play out in January and February, right? Where we saw these like sort of very swift sell-offs in industries when conventional wisdom decided that this industry is going to be ruined by AI. I think it's too early to know how exactly this plays out. We certainly want to be alert to it and follow the evolution of this. But I suspect that more often than not, we're going to see industries that are enhanced by AI. I look to China, which of course, because it's a more directed economy, is more involved in how AI is utilized. And there's a really big focus on utilizing AI to make the manufacturing sector more productive. So it could very well be that we see many, many industries just benefiting from AI. That's not to say that there won't be areas that are hit that are not anti-fragile. We just don't know yet. It's very similar to having lived through the tech bubble. What was assumed in 1997 was not necessarily what played out by 2000. And so I look at this phenomenon with that same level of humility and say it's very hard to tell.
Let's move to some personal reflections now. We've talked about the course of your career and how it took some unexpected twists and turns, but you can join the dots now looking backwards. Were there any particular highs and lows there? And the reason I ask this question is because I always love to know whether some of the setbacks or challenges may have given rise to learnings.
So I think we learn from every mistake. I also have learned just from experience, making mistakes and being successful at something. And I point in particular to, as a young person, having the benefit of sitting on an endowment. This is not the college endowment, but the high school I went to, the secondary school I went to, I sat on the endowment committee. And it was a very interesting experience because it taught me the value of investment policy statements. It taught me the value of creating and making decisions around asset allocations in an emotional vacuum and preventing one from making huge errors in times of panic or in times of high levels of emotion. So there were certainly mistakes that we made along the way, but my biggest learning was actually from the global financial crisis, when many of the very seasoned portfolio managers who sat on the endowment wanted to get out of the stock market. And it was late February. And I remember sitting on a call with them, and it was the first time we ever shouted at each other. And the only thing I had to, and maybe this was the lawyer in me, the only thing I had to rely on was the investment policy statement and how we couldn't blow out of equities now. And so while I'll fully admit I made a bunch of mistakes along the way that I learned from, I was really happy that I did stick to my guns and we didn't get out of equities then. We didn't add to it, which was my mistake. At that moment, we didn't add to it, but I am happy that we were able to stay in. So that taught me a lot and has stayed with me.
Isn't it funny how these crises, they just put a mark on us. They tattoo, I think, that experience almost on our mindset and our approach. It's interesting how that one I think the great financial crisis has stuck, whereas some of the wobbles, even COVID, I think some of the learnings from that have seemed more superficial somehow. I think we are the better for it, for sure. Speaking of people who've had an influence on you or been formative in some way, bearing in mind this is not exhaustive, any key people at all that you can mention that had a particularly important role in your career or development?
Oh, absolutely. Well, my mom, probably you get that from most people, but my mom was a feminist before her time and also was a realist. And I remember her saying to me when I was in college, when I graduated from college in 1957, there were 3 jobs available to me: teacher, nurse, or admin assistant, all incredibly admirable careers, but not the great variety that were available to men. And so she said, just keep in mind how lucky you are to be able to graduate at a time when there are so many options. And she made me realize that I stood on the shoulders of giants. So I thought that was very valuable. And of course, she encouraged me along the way. She was the first person to pay for my Wall Street Journal subscription when I was in college, when she saw that I enjoyed the investment club so much. So, all credit and praise is due to her. And then I would say, I went to a Catholic school all my life, and I was really shaped by the nuns and some of the lay teachers there. For those who've never met a nun before, they've missed out. Some of the most incredibly strong people I've met, fearless, and they forced me to think about being a good person in addition to being a good student. And that's often hard to do with young people.
Another Catholic school product of nuns here speaking with you. So yes, I would agree. And yes, fearless at times as well. These paragons of learning are really definitely, again, talking about things that make an imprint on you. And my last question is around any creed or motto. We're talking about nuns and Catholic school, and creed seems an appropriate word to use here. Any key belief that you maybe identify with or that you would pass on as your wisdom?
Oh, absolutely. So this was one of my lay teachers had said to me and repeated it so many times it became ingrained in me, but for the grace of God, there go I. And I think we've all met people, especially in this industry, that were born on third base and think they hit a home run. And it's so absolutely important to realize that so much of this is luck and good fortune. I think the corollary to it and the other motto that's so important to me and also came from that same teacher is, to those whom much is given, much is expected. I think that's so important because especially in this industry, we have great knowledge that we should be willing and able to share with others. So I think the ability to do pro bono financial planning, all those things can make such a huge difference in other people's lives. Sitting on the endowment of a nonprofit, all those things I think are, to quote, I think it's Marion Wright Edelman, that's the rent for living here.
Well, thank you so much, Christina. The times we live in are volatile. I mentioned the word melt up. They're uncertain and they're changing. I think what we need more than ever is an anchor and a strong set of core beliefs that can carry us through these uncertain times. And from the beginning, when we first met and throughout this podcast, I think you have been a representative of that kind of strong anchor belief going right back to your origins and Catholic school and some of those beliefs that have carried throughout your career. So thank you for being such a pillar of our industry and one of my anchors. Thank you for sharing your insights here with us.
And thank you, Ethan, for doing the same. It is a huge honor to be on your podcast. So thank you.
I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.